climate change is a very multifaceted issue. So you have both the risks and opportunities, and broadly you can break them down into two. First you have physical climate change, which obviously means higher temperatures and more extreme weather events. The second thing is transition. So transition means regulatory change, but also technology change. And as part of that, we think there's an inevitable decarbonisation to happen if we're going to meet the Paris Agreement. That's going to be driven by regulatory change, but also technology change and also private capital flows changing. So based on that, when we assess a company, we think it's not enough just to look at carbon emissions, because carbon emissions per se don't always tell the full story. It doesn't show the future emissions for a company. It doesn't take into account the engagements we might have done with the company. And also it doesn't take into account physical climate change risk and a whole other set of issues. So we think a better way to assess company is to look at the net risk and opportunity of a company, where we take all these things into account. And based on what I just said before, we think a company like Macquarie, for instance, is an interesting case. And why am I saying that? It's because in the ASX 200, you don't really have a lot of renewable energy exposure directly. But through Macquarie Group, you can have that indirectly. So they acquired the Green Investment Bank in the UK, and renewable energy is a major investment theme for them. So we think that's a good way for us to leverage an opportunity on climate change.